This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today on the download, have a little bit of an interesting news segment on the market. As everyone kind of probably knows just from tangential news sources, it's been a little wild out there, but just some, kind of some salient points to bring across. Fannie Mae just released a report that home buyers have reported the lowest sentiment on affordability since they have been recording and tracking this sentiment in the market since the mid 90s, which is interesting to say the least, that people are feeling discouraged while we're still seeing record home prices and home sales. National Association of Realtors releasing that the sale and price of homes rose by an aggregate of almost 20% in March, which is the last available figures that they published. So the lending side of things, Fannie Mae being the governmental backed loan issuer, showing that the sentiment on the pricing and availability for home buyers is very low, but yet the numbers trending on the actual sales and prices going the other direction is certainly something interesting to look at. Now, what does this all mean? Is it kind of a pointless metric to throw out? Although it is kind of a very vague thing for them to put out by just saying, we are saying that the sentiment is bad. And it's kind of interesting to look at, the continued home prices with also low availability, but also people continuing to buy them at these incredibly high prices. Where will this go? It's uncertain, but at least we're starting to see that some more public data, at least bigger data sets of people being polled are showing that these sentiments are down. And hopefully with the increase in the mortgage lending rates that the Fed has put into place, with the 30-year fixed rate sitting right about 5.5% as of the recording of this podcast, might have the effect of cooling down the housing market a little bit and increasing affordability for some of these home buyers. So it'll be really interesting to see what the next coming months show, and hopefully into the next year show, that people can start buying houses for maybe a slightly more affordable rate, and that we don't see some type of precipitous cliff edge as we did in 2008 with a huge crash. Personally, I don't think that that's necessarily going to happen to the degree that it did then. Will there be a correction? I mean, absolutely. Markets go in cycles, but it'll be interesting to see what kind of drop off we see and just how much of a correction actually is out there. Reuters is reporting that retail investors are having the bleakest forecast for short-term returns since 2007. Kind of coupling that with what Fannie Mae was saying, it's not necessarily a good thing, especially for the short-term investors, and at least for those people that are relying on dividends and cash flow from securities. Wild stock price swings and depressed values of securities can certainly help to drive big issues for Americans, especially of those that rely on retirement plans that are heavily invested into publicly traded securities. So seeing these kind of issues crop up hopefully isn't going to be an indicative of some type of very big market correction. Obviously, we're going to see one at some point, but at least for the fact of what it's going to look like for the investors, hopefully the outlooks start to improve a little bit. But it is something to be aware of. It should be something that, you as the investor stay on top of if things are starting to be a bit tumultuous. Maybe looking to diversify a little bit, or at least change some strategies, wouldn't be a bad idea. Now, doing some type of fire sale, cutting and running at the first sign of trouble, probably isn't the best idea for a lot of people, but at least starting to sit down and say, hey, is the music going to stop in the next coming months or year? How am I protected? What steps can I be taking now to help prevent a lot of pain in the future is probably something very good for a lot of investors to do. So, having those kind of conversations with your financial advisors, your spouses, whoever else is affected by your finances, now is probably a good time to start taking some looks at those with what is probably coming in the near short term or midterm futures. Cryptocurrency legislation is moving through the House that would give the CTFC oversight over things like Bitcoin and Ethereum. The actual publications of what is contained in this bill have not necessarily been released yet, but it's kind of a good move for the investor side of things. Granted, the slightly wild west attitude of cryptocurrency investing has made for people being able to make a lot of money, but it also, especially with the complete collapse and dissolving of Terra Luna, we see that huge amounts of market capitalization can be wiped off the face of the map. Now, not to necessarily compare, say that there was any type of fraudulent activity, but comparing the market capitalization fraud from Bernie Madoff to what happened with Terra Luna, there's only about a $500 million difference in the total amount of value lost to the investors between those two things. So seeing that a whole market can be affected by something on the scale of what we thought was going to be the largest issue to come out of some type of fraudulent activity in a particular investment market is something that should definitely lend itself to having a little bit more oversight. Now, again, what this will actually mean, what form it'll actually take is hard to say, but with cryptocurrencies being such a interesting market for a lot of people that maybe don't necessarily understand all of the risk associated with that, some type of legislation coming down the pipeline that will help to effectively protect investors a little bit and give a little bit of guidance to this otherwise unregulated market is probably going to be something that helps out a lot of investors in the long run. Of course, we don't like to see large government constriction on the ability of people to make money, but with how inherently risky and available these investments can and tend to be, seeing something that gives us a little bit of guidance and a little bit of protection to the end user investor is probably good, especially with companies such as Fidelity, one of the largest retirement plan administrators in the entire US, allowing for cryptocurrency investments to be utilized through 401k accounts, especially as it relates to Bitcoin, which is, again, seen as one of the more stable and certainly one of the longest running cryptocurrencies out there. But especially when you have exposure, at least financial exposure, to so many people that is now available to these types of investments, it's probably good to have some direction and at least a little bit of guidance from the federal government on some regulations in this market. So we'll see how that fleshes out. I'll certainly be updating you as I get more information on this once we get more information on the bill and how the CTFC is going to actually be levying their oversight if it passes. News from the meme lord himself, Elon Musk, is reviving his assertions that Twitter has a bot problem over 5% and is threatening to pull his purchase offer. However, with this kind of humongous purchase agreement, it is not something that buyer's remorse is necessarily tolerated for. He is a big proponent of, or I shouldn't say proponent, maybe he is a big user of social media to voice his concerns and to sway stock prices and sentiment in certain directions. And it's definitely interesting to see what's happening here with him publicly coming out and saying that the bot or fake user issue with Twitter is up closer to the 20% mark. His ultimate strategy with that, although there has been no verification of a bot or spam user account basis for this company over 5%, which was the threshold marked in the initial purchase agreement. It'll definitely be interesting to see just kind of how this whole thing plays out. Again, it's not necessarily something that we can make any huge speculation on. However, with the current downturn in the market, the share price, the purchase share price that was agreed upon in the purchase agreement is something that's starting to look much more attractive to the other side of the table than it is Elon Musk. So we shall see what happens with that. It's definitely interesting, if not just entertainment, to look at in the world of investing to see a single individual come up against such a large conglomerate and see what happens. Ultimately, it'll be something to hopefully that the end user investors don't get burned on, and hopefully we can all sit back, eat a little popcorn, and see what happens with this. Because if nothing else, it is a little bit entertaining to watch. Amazon has rallied 25% in trading on Monday after a 20-to-1 stock split. Quite a large stock split for a company that rarely ever splits its stock, but it has helped to bolster share prices. They've been on almost a 2-year slump with their share prices. pegging up and down a little bit, but mostly on a downward trajectory for, I shouldn't say 2 years. I think it's probably closer to about 18 months, maybe. But seeing a 25% increase in share price on Monday after the 20-1 stock split last week is certainly interesting to look at. The e-commerce giant certainly is a very well entrenched and probably a quote not going anywhere type of company, although we have seen many companies of large size go many different directions over the years. It's definitely interesting to see that such an aggressive stock split had such a positive impact on share price after such a large slump that they've been on for the past little while. So with that said, kind of what we'll round up the download with on today, the U.S. Treasury is making a statement that they haven't made since 1994 regarding the currency manipulation of the People's Republic of China. Treasury Secretary has officially labeled China as a currency manipulator after the People's Republic of China devalued its own currency in response to new tariffs. And this is the first time since 94 that the Treasury has actually applied this currency manipulation status to a governmental organization, which is absolutely wild that this has actually occurred. The Chinese currency has typically been seen as a relatively stable peg to the US dollar as far as what its value is in relation to other currencies. Obviously, it's not 1-to-1, but the ratio has always typically remained the same. So the devaluation definitely causing large issues when it comes to the large amount of trade that is done between the US and China. So seeing how this is going to play out will be very interesting, especially since it is such an aggressive move from a trade negotiation standpoint for the Treasury to label them as a currency manipulation and placing the restrictions that come with that and monetary policy to the People's Republic of China. So definitely a very interesting news cycle as far as posturing when it comes to governmental reports, if you will. I don't even know what to say necessarily on what it is when the U.S. Treasury does something like this, because the last time they did this, let's see, I would have been in first grade. So it's definitely interesting to see that something that has rarely ever been done before is now being applied in this current economic climate. So that's what we have for the download. Thanks for joining. Today on the what is the applicable federal rate, or the AFR? Something that people may not necessarily have heard of. People normally are used to hearing APR, or annual percentage rate, but there is another part of the bounding of lending in the United States that regulates the lowest amount of interest that can be charged on a loan without it being considered a taxable distribution to another party. Now, for most people, what you need to understand is when you borrow money, you don't consider it income. You don't consider leveraged or liabilities as income. Even though you received a large tranche of money, you've agreed to repay it back. However, in the IRS's summation, if you charge a rate that is exceptionally low or outside the bounds of norm, then really it's just kind of an attempt to get away from gift tax or income taxes or things like that. So they set a lower bounding limit for what you can actually charge on a loan. So here's an example of how to use AFR. As of April 2020, the IRS stated that the annual short-term AFR was 1.26%. The midterm AFR was 1.87%, and the long-term AFR was 2.25%. This means that if you were to borrow money at below that rate, you would then in turn have to pay taxes on the amount of money that you received at a pro rata against the difference of the AFR to the actual interest rate being charged. So it's definitely something interesting to look at. This has been the AFR, and this is on the What Is. Thanks for tuning in to this edition of the Alternative Investing Advantage podcast. Today, we don't have a guest, but something that I really kind of have been wanting to talk about for a little while with everyone is the benefits of diversification, and especially when it comes to retirement plan assets. A lot of people just really kind of aren't of the understanding of just how diverse you can be with retirement plan assets. A lot of people are under the assumption that if you don't buy something, and when we talk about retirement plan assets, what I'm talking about in this context is accounts like 401ks, IRAs, defined benefit plans, health savings accounts, education savings accounts, SEP IRAs. A lot of people are under the assumption that unless you purchase something like a stock, bond, or mutual fund with your large brokerage, then if you wanted to buy any other type of asset, really anything, that you'd have to pay potentially taxes and penalties to extract that money out to make the investment. There really isn't a mechanism for having a little bit more diversity within these types of plans unless you are some type of incredibly high net worth individual that has concierge level service at a large brokerage like Fidelity or Northern Trust. And I kind of want to break down some of the different asset classes that are available to people and what some of the perceived benefits to those are, especially in the context of just how tumultuous the stock market has been and for the likelihood in the near term future will be. Granted, we have been on quite an amazing run since about, I believe it's April of 2020. It has been basically a 45-degree angle straight up for the entirety of the stock market. And now we're starting to see a few cracks start to form with large indexes starting to degrade their outlooks, some people missing earnings reports and things like that. And the bad part about that is that when you're invested into securities, especially if you're someone that maybe needs to rely on, cash flow from a 401k, or you need to rely on dividends and things like that from these accounts, that those types of cash flow options for you are going to be directly pegged to the share price of the underlying securities. So if the value of your assets drops, then the amount of perceived cash flow that you're going to be receiving will drop commensurately with that share price dip. So being able to invest into things that are inherently, and when I say more stable, I'm talking more about the actual tangibility of the actual asset. Now, stability is kind of framed in a few different ways. You could say, oh, well, something is stable because I can reach out and touch it. Or you say, oh, well, something is not stable. Even if I can reach out and touch it, the price fluctuation is what I'm looking at. So what I'd like to kind of drill home is how the benefits of some of these other types of alternative assets can be, in certain instances, a hedge, or at least a play against, and if nothing else, just a greater degree of diversity that you'll have. Because in reality, when you invest in publicly traded securities, yes, you could be diversified in the actual holdings that you have as far as what markets they're in. You could own shares of, let's say, IBM and have a tech company. You could own shares of ExxonMobil and then have energy exposure. You could own shares of John Deere and Ford and then have manufacturing. So you can dip into different industries, but at the end of the day, all of those things are going to be tied to securities markets, and million and one different factors can affect trading on a security market, even if the underlying industry is not affected at all. A good example is the ongoing horrible conflict in Ukraine, between Ukraine and Russia. It had the effect of causing ripples through the entirety of all the traded securities markets, basically causing big blips to happen where almost everything, regardless of whether it was directly affected by this conflict or not, to decrease in price. Now, so much of what the stock market is built on the actual share price. And if that's what you're kind of basing your investment strategy on, you can kind of see, and hopefully have seen a little bit, just how tenuous some of the price points of this stuff can be when halfway around the world, two countries fighting can cause your shares of a tractor company to go down. So what I want to kind of go through today is some of the larger benefits of utilizing alternative assets within retirement plans and kind of how that necessarily works. Because again, a lot of people may not necessarily even realize that there are other alternatives out there. So first off, I want to point out at least how things are purchased with retirement plans. And again, when I say retirement plans, talking IRAs, 401ks, defined benefit plans, the like. When you actually buy something with it, and this applies to stocks as well, that asset is registered in the name of that IRA directly, not you personally. So if you were to, let's say, buy a share of IBM, it would be registered as Fidelity Trust Company for benefit of John Smith IRA number. So that's how you have to understand at least the basic principle of retirement plans that buy assets. It is one separation from you, and due to IRS regulations, they are held in what's called custodial accounts. So not something that you personally own, but your IRA. And an IRA is a separate entity from you. Now, the actual ability of you to buy anything with a retirement plan really isn't regulated too much by the IRS. Really, the IRS only has very minimal regulations on what you can and cannot buy. And then there's a few people you can't deal with. So you can't buy anything that has its value based in collectability. You can't buy a life insurance policy directly. And you also can't you can't buy anything. You can't buy collectibles. You can't buy life insurance. However, you can buy certain types of bullion content traded coins. And there's also a few people you can't directly deal with. Past that, it's left up to the custodian in order to determine what type of assets that they will administer in those accounts. Now, the people you can't deal with are, if you look at your family tree, anyone directly up and down from you, and then your spouse. So nuclear family is out. You can directly purchase and sell assets from an IRA or from someone else to your brothers and sisters, your aunts and uncles, all those kind of people. You also cannot sell or trade anything to a business entity you own or control. So if you say, oh, well, great, I own this asset within my LLC or a trust I am the beneficial interest holder of, can't do that either. So again, just a few things you can't buy and some people you can't deal with. Past that, it's really the custodian that you deal with, whom holds that account for you as to what specific types of assets that you can actually acquire. Now, the first one I want to lead off on, just because it's a large part of what we do here at Advanta IRA, is real estate. And it's also something that's been getting a lot of press lately, and for good and bad reasons. But one of the big things that a lot of people look to for real estate is one that, unlike with a share of stock, and this can be relevant to things like if you look in the context of like what happened with Enron, you held stock in that company and then it went away. There was nothing past just the good faith and the operations of that company that was providing value to your retirement plan. There was no ability to walk out in time. You could have walked over to where their offices were in Houston and touched the building, but you didn't own any part of that. You just owned, in theory, a portion of the company pursuant to stock laws or stock trading and laws like that. So when it comes to actually buying something that has a tangible nature to it, real estate is something that a lot of people look to directly. And there are some big benefits to it. Now, granted, in the current market, things are very expensive, but if you're buying for different strategies, price doesn't always necessarily make a difference. And with how creative you can be, if you have a custodian willing to work in the bounds of creative deal making, then you can really start to see some great benefits from this. So one of the big inherent benefits to buying real estate, especially within a retirement plan, is that you can buy for cash flow. And unlike with a publicly traded security, let's say that pays a dividend of 1%. So if you have a $1,000 of a certain stock, you get $10, however often they pay that. Whereas if, let's say, you bought a house, and that would be based on the actual share price, so $1,000 value give you that $10 dividend. Now, let's say you purchase a home with an IRA. Now, again, remember, the construct of the IRA buying it, you're not taking money out. This isn't a taxable distribution. You actually purchase the alternative asset, in this case, real estate, with the IRA. If you're purchasing for cash flow, then you can be relatively price agnostic with it. You can work it out to where if you purchased a piece of real estate, if you bought it for, let's say, $300,000 with your IRA, and then everything flows back with rents at, let's say, $3,000 a month. If that price of that house goes up to $500,000, or if, let's say, it drops to $150,000, but it always rents, let's say, for within 5% of what you initially rented for, or just like in most rental markets, you can continue to increase rents year over year, because historically, you look back, rents don't go down. Share prices go all over the place. You have to work with inflation, but things like leases and rents always go up. It's just an inherent peg against inflation that the cost of these things will always inherently go up. So you can see where if you're buying for diversity and protection against larger things like stock markets, granted, if you're trying to buy a house and then flip it and sell it, yeah, you need to be price conscious and make sure that if the IRA is going to be engaging in something, you're not going to be, taking a bath on the purchase. But it does allow for price discrimination from the actual underlying cash flow, is that what you bought it for is not going to necessarily affect your bottom line of cash flow if that's what you're buying for. So that's one of the very big benefits of utilizing something like real estate in a retirement plan. And then also any and all of that income is not flowed through to your personal income statement. It goes directly into the IRA, tax and penalty free. It's not considered a contribution. Remember, the IRA owns this piece of real estate, and then it just continually provides tax-free income to the IRA, which you can then draw out, or you can leave it in to continually compound tax-free. You also have a great way of making creative deals. I have seen in my 10 years of doing this hundreds and hundreds, if not maybe thousands, of creative deals made specific to real estate. Everything from people getting creative owner financing if their IRA didn't have enough money, where the owner of the property actually wrote a note and the terms of the note were something advantageous for both the seller and the IRA. You also have a lot of variety when it comes to investing in real estate. There's a million different kinds of real estate out there. And depending on what is available to you in your area, if you want to buy something local or if you want to expand your horizons, again, you're not just buying, on a securities market, a share of stock or maybe a share of a mutual fund. You actually get truly different types of investments within the same asset class. So I'm talking about buying things like a single family home, let's say a 3-2 block house in your neighborhood next to churches and schools and parks. That might be something that you really look for. Or maybe what a lot of people are looking for now are things like mobile homes. You could buy mobile homes with your IRA and get into real estate for significantly cheaper while still maintaining a relatively good level of rental income for your IRA. That's absolutely something you can do. And you can also get creative with how you take title to these things. You don't necessarily have to have the IRA purchase it directly. If you know someone that's putting together maybe a limited partnership or an LLC or some type of land trust, IRAs can be involved in those types of assets to get exposure while also being protected under some of the structures that many people like to utilize for buying real estate. And to that point, again, it's not just necessarily the single family real estate that is available to you. Again, with the custodian's allowance, you can certainly buy things like commercial property. We have a lot of people that like to invest in real estate, such as larger that like to invest in larger apartment complexes or self-storage units. And one thing that's becoming a lot more popular recently are things that I never would have thought of, which are self-service car washes. It's really kind of interesting to see just how diversified when price points start getting high in one market where people can find value. And on a stock market, you're basically just looking at the price points of all these different securities. You don't really get to truly diversify, the underlying asset with that. Whereas with real estate, like I said, I talked about buying the single family home, and then you can move all the way to buying a car wash, things that are still based in real estate, but really couldn't be more diametrically opposed than, a 3-2 block house and a self-service car wash. But both are inherently real estate in two completely different ways to make money, but are still available to you and are still something you can walk out and physically place your hand on that your IRA actually holds title to. Also, another really interesting one is storage units that I've seen people invest in. We've all kind of seen the shows with people going out and purchasing, lockers full of other people's junk, but you can actually own storage unit facilities within IRAs. I've seen people put together limited partnerships for the sole specific purpose of either developing these types of structures to actually then in turn rent it out and hold the self-storage units, or actually people that have invested in a multitude of different ways. So again, everything from single family homes to limited partnerships to car washes, to storage units, and even some people that invest in raw land. People investing in raw land have a bunch of different plays for it. You could sell it to a developer. I've seen people that have bought woodlands and then sell hunting leases on these lands. So the important thing to understand is that no matter which context that you go with something like real estate, any and all of the income that is derived from your investment strategy goes back into the IRA tax-free, and the IRA is the direct owner of that asset. And again, this is an asset you can reach out and physically touch. You could throw a water balloon at it. You could drive by it in your car, which is a degree of security and also a degree of diversity that is simply just not offered in the traditional stock markets. Granted, some people might make the argument, well, you can invest in publicly traded REITs. Well, yes, that certainly is the case. And there's a lot of laws and legislation regarding the actual investment and the capitalization of REITs. But the downside of REITs is that one, they are highly illiquid, meaning that if you purchase one, typically you aren't allowed to sell it, or there is some type of penalty or some other type of issue with actually marketing that REIT that you've purchased. And then also, cash flow tends to be relatively low with REITs, whereas with an IRA or retirement plan buying real estate directly, you can basically collect all of the benefit of the rental markets, or you can take advantage of the appreciable gain in equity in selling the property, and all while taking all of that into your retirement plan without paying a dime of taxes. Because remember, these are separate custodial accounts from you personally that get to absorb all of that without anything hitting your personal tax return. So real estate is something that I really believe in. It's been something that, personally and familially, I've had a lot of experience around and seen the benefit of just how good of an investment it can be. Granted, just as with any investment, you need to make sure that you're doing your due diligence. You need to buy right with the right strategy in order to make, a good investment. But again, these things are something that need to have research done, but there is a lot of benefit, especially in the context of just how tumultuous stock markets can be. It's definitely something to look at. Now, the other side of real estate, a lot of people say, well, owning real estate, especially within the construct of an IRA, seems great, but there's liability issues, there's repair and maintenance. I like the idea of getting involved in alternative assets. I like real estate, but owning it just doesn't seem like a good fit. Well, there's a lot of fair arguments that can be made there. With real estate, you do have a lot of expenses that you don't get to capture, like on a personal tax return as a write-off, because the IRA is not filing a tax return. Things like any expense, if you need to replace a water heater, you got to pay insurance, property taxes. Your IRA has to pay all those. Well, if you want to get invested with the benefit of real estate, you could be invested on the lending side of things. In the earlier part of this podcast, we talked about Fannie Mae, talking about investor sentiment. There's large federally backed lending institutions. Well, who's to say your IRA can't be a lender as well? You can absolutely do that. We have people that have utilized their IRAs instead of buying the real estate. They want the security of real estate. So they, go out, find investors. There's either services that put together lenders and investors, people that don't want to go to a bank, that want to deal with someone a little bit more directly. Or if you know people that are investing in real estate and you want to utilize your IRA to benefit of that, you could lend them the money to buy the real estate. And it's not something where you're just kind of handing over hundreds of thousands of dollars and saying, I hope I get it back. Your IRA can actually be listed on a promissory note and have a recorded mortgage. So that way, if your IRA does not get repaid, you get to foreclose on that property and the IRA takes in the property directly. And then the IRA could sell it, could hold paper and do a carryback note and finance the property purchase out of someone else. But the big benefit of doing lending with an IRA is that you as the client get to determine all of the factors about how you're getting paid back and basically get to set up and tune in every single variable with regard to your investment. You get to choose how long your money is going to be deployed. You get to choose how much money you're going to make with the rate of return on that investment. Keep in mind, just like we talked about on the what is with the AFR, there's a certain minimum that you can charge, but there's also maximums of interest you can charge, which is called usury laws. Check your local listings for how well that is in your particular state. But if you don't want to have the issues of tenants and toilets and potential liabilities with buying real estate, using your IRA as a lending platform can still get you with the security of real estate. So that way, let's say the market tanks and they can't pay you. Well, you still take in a piece of property that can still cash flow. Now, with the securities market, if you own a dividend stock and the value tanks, well, you really have no other recourse except sell it for a loss and maybe try to recoup that on your personal income, or just maybe ride it out and just take less cash flow. Whereas in this case, you might have the headache of doing the foreclosure with the IRA, but then you get to supplant the principal and interest payments with rental income, or you can sell the property or whatever you need to do. There's a lot more options when, let's say, something happens with a mortgage, so long as all the I's have been dotted and T's have been crossed, then you might have otherwise investing in stocks if you're investing for cash flow and things like that in a security market. So mortgages are a fantastic way to get into investing in a real estate backed asset without having to actually buy the real estate. And again, you can always look at these things in regards to security-backed, mortgage-backed securities that are sold on Wall Street, where they package all of these mortgages in tranche and then sell them as a securitized asset. If you're interested to see how that played a big role in the financial downturn of 2008, watch the movie The Big Short. Good for a few laughs, but also a lot of cringe as well. So if you want to get invested directly in mortgages, you can do that with a retirement plan without exposing yourself to the hopefully well-structured secure mortgage-backed security that is being sold on Wall Street. You actually get to deal directly with the person. You can drive by that house and look at it. And if it doesn't get repaid, your IRA will then own that house. So it offers a lot of security in that aspect. But let's say you're an investor that wants to maybe swing for the fences a little bit more. You want to stand a little closer in the box and really try to knock it out of the park. Well, you could certainly then maybe get into something like unsecured lending, where you are lending someone a personal loan. Think how much they charge you on credit cards, which essentially is an unsecured loan to you personally. You could have your IRA act in that capacity, where you lend someone the money directly, and then you can potentially charge a significantly higher interest rate, but you do take on more risk, just like a credit card company does. You can do all of these different kinds of things because remember, the IRS is not writing the playbook. They allow for the companies that administer these types of accounts to open up the doors to clients to be creative with this stuff. You're not simply just limited to what Fidelity or any, I hate to kind of use them as a scapegoat for this, but any large brokerage is going to constrict you to simply just what is traded on their platform and essentially what is a tradable security. So again, these kind of things are definitely open to you. And also with lending, it kind of gets lumped into the broader context of paper assets, meaning, something you can't actually reach out and touch, but there is some other types of alternative paper out there. Mortgages, you do have the property, unsecured notes, you have to go after the person. But with paper assets, you can also do things like options. Now, I'm not talking about stock options. I'm talking about maybe real estate options, where you pay for the right, not the obligation, to purchase something at a certain price in a certain period of time. This can let you control things like real estate without taking ownership of it and having a vested interest into assets that otherwise would be much more expensive for a much lower value. So options are a very interesting thing to invest in. Also, things like tax certificates and tax deeds. You might have heard someone on a radio talk about it. It's kind of, for whatever reason, the courses that teach them are kind of a little bit more popular and more maybe old school communication methods, but you can do things like that with an IRA. And when you buy tax debt, typically those are paid back in double-digit returns if you purchase those. So another really interesting way to invest in something that does have some type of real estate backing, or at least some tangible backing, rather than, again, just the hopes and wishes of companies acting in good faith. Now, I guess me saying that kind of segues a little bit ironically into kind of the last big chunk of things that I want to explain to people on just some additional options that are out there to you is private stock. We always hear about companies, going public, big ones like, let's say, Uber and all the people that own the stock before it was public. Well, how did they do that? Well, if you're an investor and either you are an accredited investor or are someone that maybe worked for a company that they were offering some type of stock option purchase to their retirement plans, and you wanted to exercise that right with an IRA, you need to have a company that'll be able to handle that. And, not too shamelessly of a plug, but certainly we do that here at Advanta. But let's say maybe not in that broader context, but someone's starting up a business and you want to have a chunk of that in your retirement plan. Now, these are really kind of getting into the extreme of higher degrees of risk. I was really kind of shading the first portion of this first portion of this podcast as, the addition of security and tangible nature of these assets. But if you're someone that wants to maybe just go for more diversity, or you're maybe a little bit more risk tolerant and you want to have the great tax advantage of a retirement plan, being able to take on, a 3, 5, 10, 50x return on your initial investment, then being able to invest in startup companies is a pretty good option for you. So if you know someone that's starting up a company, or you have the option to buy into some type of stock or equity in a company that's being offered, that is also an allowable investment. Securities don't strictly have to be publicly traded to be held by an IRA. I know I sound a bit like a broken record, but you have to have a custodian willing to hold that. So if you do, you can certainly invest in maybe a Series A offering where you're buying straight equity, or maybe something like a limited partnership, which again are very, very popular with commercial real estate syndicators, people putting together large syndicators or large deals for commercial real estate. Limited partnerships are a very popular type of private security, but it doesn't necessarily have to be equity. You could buy something like a convertible note where you lend the company money and then they can convert that debt to equity in the company at a future date or repay you. Now, those are some really interesting types of investments that I've had the pleasure of looking through, and I really kind of find them very interesting. But the big kind of broad concept that you need to understand here is that you're not just kind of limited to any small portion of any type of asset class that you want to utilize for diversity within your retirement plan. You can actually go in and make these deals work as best as you can for what you're trying to accomplish. Now, again, you just need to kind of understand that there are minimal rules and regulations. If someone's putting together, if the person putting together the company is, let's say, your son, you can't use your IRA to give them their startup capital. You can't do that. Let's say you also want to, buy a property. I had this actually happen to a client. They bought a property in Auburn, Alabama to rent it out to college students. We got the lease, and one of the women on the lease had the same last name as the client. Found out he was trying to rent it out to his daughter and friends. You have to understand there are some rules regarding this. It's not simply just kind of do what you wish. You have to understand that there are some rules with this. You can't do any self-dealing. You can't get a direct personal benefit from any of these assets. So you can't go live in an IRA-owned property. You can't even stay there. People ask, well, what if I stay there just for a few days a year, because the IRS says that you can rent out your personal residence for, I think, 14 days a year, every year without paying taxes. Nothing like that applies. You have to keep everything completely at arm's length. But if you have any questions regarding that kind of stuff, it's always good to ask someone that understands. But I just kind of at least want people to start thinking of other ways to help shield themselves from the big issues that are happening in the stock market that appear to be on the horizon for stock markets right now. It's a good time to look at it, especially before things completely shift. And again, who knows? Everyone's been saying something's going to happen for as long as people have been investing in things. So it's never possible to really time a downturn. But of course, one always comes. These things come in cycles. So looking at things objectively and making sure that you have a correct amount of risk tolerance is incredibly important, especially when it comes to maybe looking at diversifying, and especially with the name of this podcast being the Alternative Investing Advantage podcast. I want to make sure we have at least one episode where we kind of go through some of the more popular alternative investments that you can do with these accounts, and just understand, how varied they can even be within the context of just something like real estate. Well, you could frame real estate a million and one different ways. So it's just good to understand. If you have any questions, we're always happy to help. My name is Alex Perny, and this has been another edition of the Alternative Investing Advantage podcast. Thanks for joining. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.